Welcome to Whole Mindset Mastery. My name is T. Whole is an acronym for Wealthy, Healthy, Optimal Life Expectancy. As promised on my channel's update, effective Monday, March 23rd, every Friday I will discuss topics regarding wealth, where I talk about personal finance, debt payoff, as well as investing for complete beginners. Today is a great opportunity to talk about wealth building for the long haul, to talk about wealth accumulation for your golden years. Because today the S&P 500 is down another 108 points and is down from 7,002 all-time high down to 63.68. And for most of you, you probably feel the pain. You probably feel fearful that your 401k is going down. But I'm here to convince you that if you're in the wealth accumulation phase where you have decades, 2 decades or more of accumulating wealth, market volatility is not your enemy. Market volatility is your friend. Embrace it, understand it, embrace it, and I'm going to show you the math behind my statement. Stock market volatility is normal. So here in fund number 1, what I'm showing you is the performance of the VINIX over the last 28 years. You see that it goes up, it comes down, it goes up, it comes down. You see the spikes, you see the bears, and you see the bears and the bulls. And that's a common market cycle. People often feel very excited when it goes up and feel very down and fearful of their savings when we are in the correction or in the bear market. Start asking what should they do with the fund? Should they sell it, making irrational decision? Keep in mind, you're not losing until you're actually selling it. It's actually paper loss when it's just on paper, when you haven't make any sell transaction. And fund number 2, I pretty much mimic exactly the starting price for that fund and the ending price for that fund, 541.74 as of March 16th. Same thing here, the actual fund, it ends in the same ending value. But the difference is I have it shown growth gradually over time with no volatility. If you're in a wealth accumulation phase where you're building wealth and you have over 2 decades to accumulate that wealth, market volatility is your friend, not your enemy. Even though a fund that have no volatility, it seems like it's always up, seems good, make you feel good. In reality, it limits how much money you actually make. In this example, I use VINIX, which track S&P 500 index from Vanguard. In my data point, I use 1998 to current. The reason I use 1998, that's when I started working full-time. Almost over the last 2 years, I've been living a dream where I have true freedom to choose to do what I do today. Actual performance of that fund back in 98, its closing price was $89.99, and you can see the different price point for each of the every Friday. And the assumption here is a household with 2 income combined $80,000. That is pretty reasonable here in West Michigan. If you have 2 people working, one person can make $30,000, another one can make $50,000, or both can make $40,000. So $80,000 is fairly reasonable here in West Michigan. If the household put in 6% in 401k and have a 5% employer's match, that means combined they would have a total weekly contribution to the 401k around $169.23 per week. So that's the input assumption here. And given that $169 a week every Friday, this is how many shares they accumulate based on the share price of that fund. So on this side is the actual real fund performance and shares accumulation. And on this side is the scenario number 2, where the fund always goes up. It never have any volatility. It never have any down, never have any correction or any bear market. So even though the graph here looks fairly favorable, where you don't see any volatility, any heartaches, any stomachache, compared to this one here where you have some highs and you have some lows. But in reality, if the stock market or the fund perform like the graph number 2 to the right, you are actually losing potential gains. So total shares acquired, looking at normal with normal market volatility, You acquired 1,684 shares based on that weekly contribution, versus the no market volatility, you only acquired 1,286 shares. That's because when the market goes down, you have more purchasing power with the same dollar amount. And when the market goes up, the same dollar amount has less purchasing power. And if you look at the fund that never goes down at all, very predictable, going up very slowly, as it goes up in share price, your purchasing power for the same dollar amount goes down. That's why your overall share accumulation for that 28 years is 398 shares less. And because you have 398 shares less, your overall total equity value, instead of $912,450 in this example, you only have $696. That's because you take the shares that you own, times that by the current value of $541.74, that equates to $696, versus 1,684 shares, times that by the current share price, that's $912,000. I keep this example straightforward without factoring dividend reinvestment. And if you're factoring dividend reinvestment, you could be losing a whole lot more by having stock, having fund that never have any volatility. So that's a difference of 23%. A fund that never have any downturn, that always go up steadily, versus a fund that are volatile, but giving you a better buying power as the fund goes down. Over time, it balances itself out, and you actually have more in your fund than you do in a steadily growth fund. The takeaway is, don't be fearful when the market is in the correction or bear territory, when it is going down and down and down. When you invest in a broad-based index fund, that could be S&P 500, VTSAX, total stock market. When you invest in a broad-based index fund, the market naturally goes up, the market naturally goes down. But if you dollar cost average, what that means is, with the same dollar amount at a set cadence, in this case 401k is every week, every Friday, if you just keep dollar cost averaging the same amount and keep buying that same fund, that broad index fund, over time you will enjoy an average 9 to 10% growth. So while everyone is fearful and while everyone is worried about their money, when you're in the accumulation phase, you should be celebrating. You should be thanking. You should be thinking about it as a Black Friday, where with the same dollar amount, you are getting more shares. You get more for your money instead of less for your money. Another way to look at it is just look at grocery. Would you rather pay more for groceries, for meat, for vegetable, for fruits? Or would you rather pay less for the same dollar amount? The same goes in investing. If the fund always go up, the same dollar amount that you've been putting into the 401k fund or any funds, you're having less purchasing power. But if each week it goes up, it goes down, and you have 20, 30 years, 40 years of investment, it doesn't matter what happened between those times. What matters is when you are ready to start pulling it for your retirement. That's when it matters in terms of your actual portfolio value. Until then, when the market is on a correction or on a bear market, walk around with a big smile on your face and say, yes, it's Black Friday. It's an opportunity to have more opportunity to grow your wealth.